Let's say your annual salary is $50,000. Investing 15% of your income would be $7,500 a year or $625 a month. If you invested that amount every year for 30 years starting at age 25, and we're assuming a 10% rate of return, you would have $1.3 million by age 55. And that's if you never increase your contribution amount. So you could and should have way more than that because you'll likely make more money than you are today. That's the power of time and compound growth. So the bottom line, get started early.
This is the common lie that you get told by so many people. Just save a little bit every month, and by the time you retire, you should be good to go. It's a lie we hear over and over again in all kinds of flavors. Here's another one.
When you start at 25, saving $100 a month, and you do so every single month until you are 65, and put it in a good Standard & Poor's 500 index fund, let's say in a Roth IRA with average market returns, you'd have $1 million.
Wow.
But if you wait just 10 years, $100 a month is $1,200 a year. For 10 years, it's $12,000. Not that much money if you wait 10 years. And you start at 35, at 65, you'd have only $300,000. So those 10 years cost you $700,000 at $100 a month.
This is just so much BS, and intuitively we know this, right? We know that $1 million sounds like a lot of money today, but will it really once we retire? We don't really have a feeling of how much $1 million is when we retire, right? But let's have a look at what is actually the real return after inflation. Because it's not just your stocks that are going up, everything is going up. Everything is becoming more expensive. Houses become more expensive. Education becomes more expensive. Medical bills become more expensive as well, right? And this might be pretty important when you're old. The official inflation rates are also BS, unfortunately, because they measure consumer goods mainly, and consumer goods over time are deflationary, right? It's easier and easier nowadays to produce that TV. It's even easier and easier nowadays to break that bread because we've got machinery, we've got more and more advanced machines. There is technological progress. So of course, goods tend to become deflationary, tend to become cheaper. But for the things that don't become cheaper, that aren't easier to produce over time, this curve here matters. This is M2, this is the US money supply. I think this is the most accurate way to actually measure how much more expensive things become. And this is going up by roughly 6.5% per annum. So if your income doesn't grow by 6.5% per annum, you are falling behind. You have to grow at least by 6.5% every single year. And so let's have a look now at the stock market returns if you adjust for that money printing. This here is the S&P 500 divided by M2. So the S&P 500 in US dollars looks quite nice, but the number of US dollars is also going up. And so this is the chart of how stocks would have returned if you invested in 1959 and there was no money expansion. This is the return you get when nobody is turning on the printing press. Since 1959 to today, you made a gain of roughly 20% in real terms, under a ton of volatility. Congratulations, you have saved for decades and decades. You put it nicely in the S&P 500. And what do you have for it? You simply preserved your purchasing power. So if you were to save $500 every month and you do this for a year, you are at $6,000. You do this for 30 years, you are at $180,000. And so this magical million that people are talking about will only be worth, in terms of real purchasing power for medical expenses, for education, etc., $180,000. You're just preserving your purchasing power. Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. It's rather a small circle. We are less than 100 people that signed up for premium. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com. And intuitively, again, this makes a lot of sense, right? Most millionaires today did not inherit their wealth. They made this through their own efforts. And how is that possible if simply saving can make you a millionaire, right? Then most of the wealth would simply be transferred to the younger generation. This is not what's happening. If you want to get the purchasing power of the top 1%, you have to put in the effort of the top 1%. Just saving $500 per month is not 1% kind of effort. If you want to make money with investing, you have to outperform through whatever kind of mechanism that is. Here are a few ideas. Instead of buying the S&P 500, you could buy technology stocks. They tended to outperform somewhat. Now let's have a look at technology stocks relative to the S&P 500. Also a nice outperformance. Another idea, surprise, surprise, is of course Bitcoin. Why do I expect that Bitcoin will continue to outperform? It's because of the supply. The supply is shrinking. The S&P 500 doesn't have a shrinking supply. If company valuations are too high, then a lot of venture capital will flow into new companies, increasing the number of companies. Bitcoin cannot expand in supply more than it is programmed for. It's the only asset with a 100% inelastic supply. If the price goes up, you can't produce more of it. Different to gold, different to companies, different to anything else. And so around 2% per annum gets lost in Bitcoin, so that's already shrinking. Then you've got the ETF that scoops up roughly 3 times of the mine supply. That's another plus 3% in demand. So you already have 5% of just raw real returns. And on top of that comes already, of course, the M2 money supply. So on a US dollar basis, we will see at least 11 or 12% per annum. Probably much more because we see more and more adoption of Bitcoin over time. But this is not an advertising video for Bitcoin. This is simply just to show you that you have to beat the market or you have to increase your income by a lot in order to become a millionaire. There's nothing against saving, there's nothing against spending less than you earn, but the focus has to be on either outperformance or on earning more. It can't be just to put money aside in the S&P 500. Another popular way to outperform are properties. Now, properties unfortunately don't work that much right now because financing costs are very, very high, but usually it's a very nice arbitrage opportunity. Because what happens with property is that you put a little bit of money down, maybe 20%, but you've got 80% of debt. Now, if that debt has financing costs that's below the monetary expansion, the debt devalues over time. So the system is working in your favor. Say you're only paying 3% per annum for your debt, but the money expands by say 7%, then you'd have 4% of a net profit on your debt. Now, if you've got an equity to debt ratio of 1:5, because you only paid down 20%, you get that 5 times on your equity, right? So you've got net profit of 4% times 5 is 20% on your equity. You get real return of 20% per annum on your equity. This is how people make money with property. But right now, unfortunately, this doesn't work because financing costs are too high. I believe very few people actually understand this mechanism. Otherwise, property prices would have crashed already way, way more. It does not make sense right now to buy, at least from a financial perspective, any property. Property is only a good investment if you can devalue a lot of debt and if the cost for that debt is lower than the monetary expansion. So this is a call for you not to just sit around. Just saving a little bit on the side will not cut it. Try to beat the market somehow. Try to buy Bitcoin. Try to buy proper altcoins if you do your research. Try to dive into property if that's your thing. Or at least if you get into stocks, rather prefer technology over the very, very long term compared to the rather traditional stocks that don't return much. If it's your first time here, feel free to subscribe. A like would be very much appreciated as well. It helps the channel grow. If you've got Telegram, you can also join us there. The link is down below. Cheers.